Hi, it's Jack here at System Trader, and in this very short video I'm going to present you GEM strategy, Global Equities Momentum, which was introduced by Gary Antonassi. The strategy is very simple, although very powerful, and the whole idea is based on momentum anomaly. And in general, momentum, it says that if market is strong, then it continues to outperform other markets, while the weak markets continue to underperform. And Gary Antonassi came out with the idea that he has a portfolio which is constituted of either the equity or fixed income. And if the equities, if the stocks are strong, meaning that they are providing the positive returns over the last 12 months, then we are having in our portfolio stocks. And the stocks are divided into two pieces. Exactly as the world of equities is divided. So we are holding either the S&P 500 stocks in our portfolio, or we are holding world excluding USA, or so-called MSCI, all country world index excluding USA. And we are comparing these two indices. And if over the last 12 months, one of these indices is stronger than the other, then we are holding that stronger index in our portfolio. If none of these indexes is strong enough to outperform the risk-free rate, in this case it's a treasury bill, then we are just switching to bonds. In other words, we can say that we are holding either American or non-American stock indices when stocks are strong, and we are using bonds as a safe harbor when stocks are weak. And how this idea is performing over the decades. And I made a simple backtest here in my software. And from 1950 to the end of 2020, we can see that the GEM strategy was giving us around 14% each year on average, of course, which is beating the S&P 500 index. But also what is very important is that the maximum drawdown is much smaller than in case of the S&P 500. By the way, this value here is based on the monthly data. So if we would be using the daily data, this drawdown is deeper, around 30%. But still, that strategy is giving a big advantage to us, because it's not only providing us a bigger return over the years, not always. And for example, if there is a strong bull market, it may happen that the simple index is stronger than a GEM strategy. But if we have the bear market, and this bear market is not lasting only a few months, but it is lasting more than, 1 or 2 or even longer years, then basically this strategy is very good for us, because we are moving to the safe harbor, which is the bond market. And once the stock market is going up again, we will join that market. And we can see it also in the portfolio standard deviation, which is the, let's say, measure which says us how this portfolio is volatile. And definitely the GEM strategy, GEM portfolio is less volatile if we compare it to the portfolio which is fully only in stocks. And also, if we go into other metrics, like for example the losing and winning years, we can see that in case of GEM strategy, from 1950 we had 8 losing years, whereas for the S&P 500 it was 15 years. So all in all, this is the strategy which is really great and very simple to use, because it's enough to look on your portfolio once a month to see which market is the strongest one, and just make sure that you keep that market in your portfolio. And now with ETFs in hand, you can do it very easily, because basically you can, for example, for the American ETFs, put for S&P 500 ETF for that index, Also for MSCI All Country World Index, excluding USA, there's also another ETF. And also you can easily find an ETF for the bond market. That's all from my side. Thank you very much for your attention and have a good day. Bye-bye.